Okay, welcome back to this week's episode, and this is on a topic that is such a prevalent question that I get from clients, which is, can I get rid of my mortgage insurance? So say you close a loan with less than 20% down and you want to get rid of your mortgage insurance at some point in the future. This is somewhat of a murky topic, and there are a lot of different details that would impact your ability to get rid of mortgage insurance. The easy one is, the only way this is possible is by doing a conventional loan. So FHA mortgage insurance, with the exception of, there are some small exceptions where you could get rid of FHA mortgage insurance in as little as 11 years. But generally speaking, for most FHA loans, it's on the loan for life. There's no way to get rid of it. So this is mostly about conventional loans with less than 20% down and eliminating that PMI at some point in the future. Now, with all of the appreciation that we've seen in recent past, clients are calling me constantly saying, hey, do I have to refi, or is there a way to eliminate mortgage insurance without a refinance and take advantage of the appreciation that we've seen? Because of course, most people's homes that bought 12 to 24 months ago, the fact is they are at less than 80% loan to value for the most part. And PMI can be a very expensive thing for certain borrowers. So this is a really important question, something that is, you should be focused on eliminating, especially in this market. You see, about a year ago, we were talking to those clients and it made perfect sense to refinance to get rid of PMI, as opposed to try and go through the channels that allow you to eliminate PMI on the current mortgage. Because PMI is always a new insurance policy on every mortgage. So it's not like you pay PMI once and then it's the same policy the next loan. It's all new on every loan. So a refinance is one good way of doing that, of course, but we're in a rate rising environment right now. Many people are not going to want to refinance because the rates are higher than the rate they have now. Even with their mortgage insurance, the costs are higher because rates have gone up. So the ways you can do this, the CFPB, which is a governing agency over mortgage lending in the US, they have a law that states that, or a rule that states that every lender must eliminate the PMI automatically once your loan hits 78% loan to value based on the original amortization. So what that means is it is not including the appreciation of your home in the future. It's based on the original purchase price or appraised value and the original loan amount. And so if you get down to 78% by virtue of payments to the mortgage, then you can eliminate PMI. But unless you're making dramatic principal reductions to the loan, I would say hundreds per month, that's gonna take a long time. In my calculations with standard monthly payments, it takes somewhere between 7 to 11 years to hit that level of 78% loan to value and get the automatic termination. However, there is a solution to this possibly. And I've got some notes here to make sure that I don't screw that up. But essentially the agencies, and the agencies are Fannie Mae and Freddie Mac. I'm discussing Fannie Mae's rules right now. And many loans, they mirror each other for the most part. Many loans are Fannie Mae loans, I would say most. However, there are options to use appreciation. Now, you as the borrower have to call your mortgage company to instigate this process. You'll have to pay for an appraisal to document the value has come up and accomplish a certain loan to value metric. And that changes. So if you're at 75% loan to value or less based on the appraisal that you received from from a third party and present to your mortgage company. Now, one word of caution, I would call the mortgage company to discuss their policies around this borrower initiated removal of mortgage insurance, because they may have certain rules. And if you go down the path of getting an appraisal and then they say, no, you have to use our appraisal company or something, you could shoot yourself in the foot and end up paying twice. However, if you go get an appraisal, ultimately by following their rules, and you are at 75% or less loan to value, meaning you owe 75% or less of what the home is worth, and you have owned your home and paid on time on your mortgage for at least 2 years. So at least 24 months of on-time payments on your mortgage and 75% or less mortgage insurance, there is an ability to get rid of the mortgage insurance. If it's only at 80%, you would have to have made payments on time for at least 5 years. So either way, these timelines are less than, the 7 to 11 that I normally see for the automatic termination. Now, there's one other caveat outside of automatic termination: borrower initiated termination, which is where you go document the value, make sure you follow their policies, and that's your servicing lender, not the person that did your mortgage, although they can help you. Like my clients, I'm happy to help you navigate this situation, but it's ultimately up to the servicing lender, which can change. Even if, Cross Country Mortgage did the loan, we may not be the servicing lender in the future. So it's the servicing lender that handles this. Make sure you understand their policies so that you don't go and waste money and time trying to go through this. But there is one other scenario where if you buy the home and you improve the home dramatically, so say it's a fixer-upper and you and your family or whatever has the ability to fix up the home, and you dramatically improve the property, which subsequently created more value, there are ways with the servicing lender to get an exception to that 2-year period. Regardless of what the loan to value ratio is, there's a way to get an exception to that period of on-time payments because you've invested so much money and improved the property. It all has to be documented. There is a process to it, but it's worth looking into because, like I said, this PMI for certain borrowers can be several $100s per month on your mortgage payment, and you don't have to refinance to get rid of it. The last, forgive me, I'm going backwards, but the borrower initiated, there is another one that is 70% loan to value. So there's 80, 75, and 70. The reason I didn't really bring that one up is because it just says at least 2 years, but the 75% says between 2 and 5. So really, I think 75% is the threshold, but what you have to recognize is the CFPB is the governing agency. So there's some ambiguity in the requirement or obligation of the lender if you initiate this request to actually remove it. So what you've got to be mindful of is in an environment like we're in today, where rates are going up, the lender knows that there's a very low risk you're going to refinance out of that mortgage. So they're less inclined to eliminate the PMI based on your request. And there are loopholes for them to essentially keep the policy in place. And that is valuable for them because it's an insurance policy that you pay for that protects the lender's interest in the property in case you default. So they're not necessarily motivated to let you eliminate this, but there are ways to do it. This is some of them. And the only other thing I would say is ensure that you are using your lending resource, like me, for example, talking to your loan officer to get the facts and allow them to guide you through the process. Because the reality is, even with rates rising, I still have clients that a refinance is worth it. And you might go down this path of eliminating PMI and think that, man, I'm saving a bunch of money because I don't have to refinance to higher rates, but you could be shooting yourself in the foot. I talk about that in another video, but it's really a concept of leveraging equity to help you pay off debt and free up cash flow, and then reinvest that cash flow back into the mortgage. And it ultimately ends up saving you a ton of money and amplifies or accelerates the payoff of your mortgage, even with a higher interest rate. So I wouldn't just for sure say you don't want to refi and just eliminate PMI. Make sure you use your lending resource, your loan officer, to assess all options to ensure you're making the right decision. Anyway, I hope this is helpful. If there's any other questions, because this is a complicated topic, please feel free to comment. I'm happy to address any more specific comments or questions that you have. Anyway, thanks for watching. It's Broch, Lassig. We'll catch you next time.